Eliza, house prices are rising at their fastest rate in more than 30 years. Is the growth across the board or more concentrated in certain cities?
The growth that we're seeing across Australia is fairly broad-based, with every property market except for Perth and Darwin now sitting at record highs. The annual growth rates have ranged from over 20% in the smaller capital cities like the ACT, Darwin and Hobart, down to an appreciation of about 15% across Melbourne in the 12 months to September.
Has the rate of increase been sustained?
So I think what's pretty clear is that the monthly rate of appreciation is now starting to ease. It looks like it peaked back in March with an uplift of 2.8% nationally. For the month of September, we saw an increase of 1.5%, and that's actually the lowest rate of increase since January this year. But when you consider that for the past decade, the monthly average movement has been about 0.4%, it does put into perspective that the momentum is still pretty strong.
Why has that rate of growth slowed down? Of course, keeping in mind it is much higher than that long-term average.
I think it's starting to slow because of the progression of the cycle. The growth rate has peaked, and it's clear that now affordability constraints or even willingness to pay is just sort of starting to slow those appreciation rates down. There are also some mid to long-term headwinds to the property market that would probably change dynamics going forward, particularly with what we've been hearing about changes to or possible changes to lending conditions this week.
I'm keen to get your thoughts on that in a moment, Eliza, but sticking with property prices, when they started increasing last year, we first saw an increase in first home buyers. Are they still driving the market?
First home buyer loans have actually fallen by over 20% since the start of this year. And when we get that rapid appreciation in housing markets, first home buyers tend to be more price sensitive. They're not able to keep up with the growth because they don't have that asset to kind of trade in. So at the moment, the dominant participant in the market is the owner-occupier changeover buyers. In other words, people who are upsizing, downsizing, moving somewhere else, and they have that asset to trade in. We have also seen a significant rise in investor participation over the past few months, but proportionally, they're still only sitting at about 29% of mortgage finance, down from a decade average of about 35% nationally.
With the number of people buying investment properties as opposed to first home owner occupiers, is that going to impact rental prices?
Well, rental prices have seen very strong growth. Rent values are up over 8% in the past 12 months. And eventually, I would say it does tend to ease rental conditions when you get more of that investment supply. But there's a couple of caveats to that. At the moment, you could argue that a lot of those investment purchases are actually purchases of holiday homes, even short-term accommodation investments. So that doesn't exactly add to long-term rental market supply. The other factor to consider is that for every investor property that's purchased as opposed to an owner-occupier purchase, you're limiting the supply of owner-occupier supply, basically. And that can actually put more demand on the rental market over time.
What's supply like?
At the moment, we're still seeing this ongoing condition where there's more sales occurring than each new listing added to the market. So total supply is quite depleted, and total listings volumes are about 24% lower than what we would usually see at this time of year.
Are we seeing price increases evenly for both houses and apartments?
Look, it's clear that over the past 12 months, demand has really been concentrated in the detached house segment. And again, that's a reflection of the high portion of owner-occupiers that are actually in the market, whereas investors tend to be more correlated with unit demand. So over the past year, that's translated to a national house value uplift of over 23%. In the unit segment, it's closer to just 10%. So in that sense, I guess apartments could at least provide a relatively affordable option for those who are really hoping to get into the market.
Eliza, there's mounting expectation macroprudential measures will be introduced to address rising household debt. When do you think that will happen, and what do you think it'll look like?
I don't think it's too far away, to be honest. RBA Governor Phil Lowe flagged earlier this year that a period of sustained increases in household debt that outstripped income growth would probably be the trigger for macroprudential policies. And in the year to June, we have seen housing debt alone increase about 5.6%, and ABS data indicates that income growth was only about 1.6% in the same period. Now, in terms of what that macroprudential policy looks like, it's fair to say it's going to be quite different to what we saw in the previous cycle of 2012 to 2017, which was really targeting the investor segment of the market and in particular interest-only lending. This time around, it looks like the measures are going to take the form of the level of debt that's going out on high debt-to-income ratios. So where that debt-to-income ratio is 6 or more, that's currently tracking at about 22% of new lending, and that could be the area that is more limited going forward. But it is worth noting there's a lot of speculation at the moment. We don't actually know the detail of what will happen, and the impact on the housing market will really depend on the design of those regulations as well.
So is it too soon to have much of an idea of what that will mean for property prices then?
Well, if we look at the macro-prudential interventions from 2017, say, it triggered a downturn. It triggered an 8.4% decline in housing values peak to trough. So I think it's fair to say that any limitation on credit is going to take demand out of the housing market, and that could change the dynamics. But the extent to which that happens, I think the devil's in the detail.
Eliza Owen, thanks for coming on the program.
Thank you for having me.